Well, hello. It's Larry Steinhouse, and guess what? We are back. It's the Larry Steinhouse Show, and I am back here with Matt Heller, and we're going to talk a little bit about insurance and all the cool things that Matt Heller can do for you, because Matt Heller is just one of those nice guys. I mean, I just like Matt. I'm going to tell you a story about Matt in a minute, but the first thing I want to do is I want to have everybody wave to Matt. All right, you got to wait to the people because they can't. They're not even seeing you yet. They don't even know you're here yet. So if you guys have anything you want to talk about, any insurance questions you want to talk about, or anything at all that Matt has to talk to you about, or that you want to talk to Matt about, feel free to leave some comments. So I'm going to tell you a story about Matt before I even start. So Matt's up here, and one day, I'm going to tell you the honest truth, and this is the real story, and he'll tell you this is the truth. Mm-hmm. I hate insurance people. Now, the reason I hate insurance people is not because they don't know what they're doing and not because insurance companies don't pay. I don't believe that. I actually have had really good luck with every insurance company I've ever been with. But insurance agents are the biggest pain in the necks in the world. You know why? Because they never return phone calls. Never. They just don't return phone calls. So you can get an insurance agent and you can call them and they won't return your phone call. Now, I'm a real estate investor. Now, I'm buying lots and lots of properties and I'm talking to insurance agents and they're not returning my phone calls. So what do? I get a hold of Matt Heller, and here he is, right? I get a hold of Matt Heller, and he tells me he's going to return my phone call. And my first thing, what did I say? What did you say to me, Matt? What did I say to you? What did I say back to you?
You said you're my guy.
Well, I did.
Yeah.
Under one condition.
If I return your
phone call. Now, and the weird part about that was he did. And I was like, get out. I can't believe it. In fact, I had just switched insurance companies like 2 months before I met Matt. Before I met Matt. Boy, that's hard to even say. Yeah. Before I met Matt, and I decided that I didn't believe Matt. So he gave me a quote. Remember, this is funny too. He gave me a quote that was $1,000 less than the other company, and I told him he was full of baloney, and I moved on, and he laughed at me. A year later, when I went back to him and crawled back to him and said, "You returned my phone call. At least now I can talk to you." And sure enough, I saved that $1,000. So I just had to tell that story because I thought it was true, it's relevant, and it makes sense.
Sure.
So why don't we talk a little about insurance, especially for a real estate investor? Mm-hmm. What are some of the things real estate investors need to know about property and casualty insurance?
Well, I think to start, they need to know that depending on the project or what they're buying, there's different requirements that they would need, as far as insurance. If they're developing real estate, they might need one certain aspect of insurance, but if they're actually owning properties, they might need another. So I think as a starting point, I think it's good to know that depending on what you're investing in or what you're looking to do, you would kind of need to direct a different maybe approach to kind of the insurance buying process.
So, as a real estate, and this, right? So as a real estate investor, I do mostly buy and hold, but every once in a while I'll do a fix and flip, right? Mm-hmm. So what kind of insurance does somebody buy for a fix and flip? Because this is a really, really important piece of information that people should understand. So what kind of policy should they buy?
Yeah, so it's called a builder's risk policy. And typically the way it works is rather than, your typical policy for, let's say, a single-family home or an apartment building, where you'd be covering, just the existing value of the property as you buy it, right? You're also going to want to insure for sort of the renovations that you might be putting into the property. If it's ground up, then obviously that's going to be purely renovations. There's no existing structure to insure. So kind of depending on, which route, you're going to go, it might be a different conversation. But for the most part, it's called a builder's risk policy. And, that's going to cover you for actual property damage to your project and from liability as well. The liability is a little bit tricky, and I can talk about that. Yeah,
so actually, I was going to ask you to talk about that because the liability is something that's important, especially in any policy, right? So builder risk policy, so what happens if somebody, wanders onto the property mm-hmm. and, I don't know, they step on a nail and they mm-hmm. get an infection or whatever it may be. Yeah. That's kind of a simple one. Yeah. What happens? How does that cover you and cover them?
Sure. Yeah. So basically, the way it works is, there's a liability component. If it's a package policy, you'll have the builder's risk and the liability together. Sometimes, they're separated out depending on the situation. But really, what you're covering is your premise liability, right? As an owner, your exposure is, things like slip and falls, that sort of thing, right? If you're involved in the actual construction, if you're the GC as well, then there's a new set of exposures, right? There's actually exposure as far as the construction operations.
So that's a great question. So if you're the GC, do you have to tell the insurance company you're the GC?
So typically, you might not have to do that, but you would want another policy for that GC entity to cover the construction exposure.
Okay, so I have a great example. A friend of mine had a property that was 98% finished. In fact, this is the story. It was kind of a crazy story where he was renovating the whole property, and the guy who was refinishing the floors took the oily rags and put them in a regular garbage can. Not you're supposed to put it in a tin garbage can, with a cover on it. And sure enough, what they say happens. Spontaneous combustion, and the whole house burnt down. So it was crazy. So he did get paid. I mean, it was a tough situation.
Sure.
He was out for quite a while for money because he was expected to sell it 2 months, a month later. But have it listed and probably sell soon.
Sure.
But in a case like that, how does that cover him? You've got this guy who's got 100% liability, which was the guy who left the dirty rags. So what happens?
So I think in that incident, I think that there would be coverage for the physical damage to the property, the fire, right? But what might happen from there is the insurance company will approach something called subrogation, right? So they'll look to recoup what they paid out in that claim. So they're going to go after potentially the contractor's insurance company and look to recoup that.
I got it, and that makes total sense. Yeah, subrogation. I pretend I don't know anything, but I used to actually have a property casualty license.
Did you?
yeah, many years ago.
Yeah, awesome.
So yeah, I had to take that.
I did not know that.
I had to take that test years ago.
Were the crazy property and casualty guy?
The crazy property, exactly. I was a crazy property casualty guy. but at the same time, you don't know everything, and
right.
I haven't taken my continuing ed obviously because I haven't been licensed in many years. But subrogation was always one of those words that I thought was a really cool word because they go after it.
Yeah,
and I've seen that happen in claims that I've had where I had an insurance company subrogate. My insurance company had a claim. They subrogated against someone else. Actually, it was Sears who came out to fix my appliance and didn't fix the appliance, and it leaked all over the house and cost like $40,000 worth of water damage.
Sure. Yeah, and so one other thing to consider too, though, and obviously, you understand the concept of subrogation, but sometimes in the contracts that you're signing potentially with contractors, right? They may ask for what's called a waiver of subrogation.
Oh, that's interesting. Wow.
So things like that could prevent subrogation.
Okay, so there's the insurance company that I get. So if I buy a builder's risk policy, do I need to show them the contract I have with the contractor?
Not necessarily. The way it's worded is anything written within a contract that requests a waiver of subrogation will basically be provided on the policy. So you can have what's called a blanket waiver of subrogation on your policy, and in any contract that you sign where they're asking for a waiver, you would automatically get that.
Huh. So basically, when I call you and to say I need a builder's risk policy, I just assume that's in there and don't worry about it.
So, as an owner, right, there's not necessarily a need for it, right? Because at the end of the day, where is there going to be potential for subrogation against you, right? There might not necessarily be. So my recommendation would be in any contract that you sign with a contractor to include that language to make sure that their insurance companies don't go after you. If your insurance company goes after them, right, that's only going to benefit you because there's going to be less claim history on your record,
right,
and your rates are going to be impacted. So, or not impacted. So you prefer to have a waiver upstream where their insurance company can't go against you than you would to have one downstream where if you're eliminating your ability to subrogate, right, then you're not going to be able to recoup that on your loss history and get potentially the premium savings or not be impacted by a rate increase, things like that.
That's actually really cool information. So let's go over to like a regular, just the regular Joe who's got a house, who's got a car. what kind of insurance yeah, okay. Well, obviously, the car insurance and house insurance, it's a silly question, but what should people look for in their insurance policy when they are purchasing insurance, for example?
Yeah, so, obviously my focus is commercial.
Right.
So getting in the weeds on the personal lines, I'm happy to do that. I think, I obviously am familiar with those types of policies. Usually,
I assume they're easier, right?
yeah,
Okay.
I mean, they're a lot more straightforward, right? Most, personal lines agents can handle, most questions. I think one of the things that people don't think about specifically as it relates to their home, auto, that sort of thing, is an umbrella policy. So that's one element that I would like to mention.
Actually, talk to me about umbrella policy, because I think this is really important for people to understand how an umbrella policy works. So give me the basics, and I want to ask you some questions on it.
So obviously, on any of your homeowners policies or auto policies, you have liability coverage, right? So on the homeowners, you might have some personal liability coverage, maybe $300,000 up to $1 million. On the auto, similarly, $300,000 up to $1 million, right? But what if, personally, you have more exposure than just that $1 million, right? What if you're concerned that, based on the assets that you have, right, you could potentially be, liable for even more than that, right?
I'll just hide mine.
Right. Yeah, and smart people do that, right? They put them in LLCs and entities.
Trust, right, exactly.
Right, exactly. And that's, something I always recommend, consulting with an attorney and going through those, situations and kind of, figuring out the best way to, hold your assets, right? I always recommend that. But basically, it just goes over and above kind of the liability limits on your auto and homeowners policy. So let's say you have $300,000 on your homeowners policy, but you want maybe up to $5 million in coverage because you have, I don't know, $4 or $5 million in assets. You're concerned. You just want to make sure you're covered. If anything, God forbid, happened, then you would just get a $5 million umbrella policy, for example, and that would just go over top of kind of the liability limits that you have in your home and auto.
So what if? So a lot of people, we obviously tell our students and we teach people to hold in entities such as trusts or LLCs. But let's assume that somebody had, for example, 10 properties in their own name, and they had insurance on all the properties. Would an umbrella policy cover all of those properties? Again, assuming that they were in their own name.
So ultimately, it would depend on whether. So honestly, there's two ways to write let's say a single family rental property, especially on larger portfolios. So you can write it on a personal lines type policy it's called a deep dwelling policy. So they'll do like dwelling policy 1, 2, and 3 like they will for a homeowner's policy, HO1, HO2, HO3, right? But they have that same product for rental properties. So if it's a personal lines policy, right, it's going to be a personal umbrella as well if they're under their own names. So you're going to have some liability coverage on that DP3, let's say $300,000, up to $1 million, and you're going to want to get a personal umbrella to go over top of that. If you have a larger portfolio, there's also a possibility that you could have a commercial policy, right? Especially even if it's under your personal name, you could have a commercial policy. So that could give you more coverage than the dwelling policy in certain ways. I'm happy to talk about that. But if you're going about that route, you would have a commercial umbrella over top of that. So the way those work is you basically schedule any commercial policy that you have under the umbrella, and that kind of lies above your commercial liability limits.
All right, so I always have this problem when I try to buy a rental property or, and I always try to figure out what the property is worth in insurance value. Because, if I pay $150,000 for a property, it may cost $80,000 to rebuild or it may cost $300,000 to rebuild.
Sure.
I can never understand the best way to figure this out. I know you guys come up with numbers. How does that actually work? Because, most of the time, obviously I trust you. So as my insurance agent, I trust you. But I never understand exactly what I'm even looking at.
Yeah, I mean, I think it's definitely, a point of contention for a lot of people. I mean, especially investors. A lot of times they're buying property distressed and they don't want to insure it to, the full replacement cost, which is really the rebuild value, right? So as that property may have been built in 1950 or whatever date it was built, right? Basically, you're rebuilding with like kind, quality, and the same materials, basically. And whatever that cost is the replacement cost. And some carriers may define it differently than others, right? They may have different systems that are calculating what that is, and obviously, you would hope that it would be consistent across the board, but unfortunately, a lot of times it's not, right? One carrier may, say that the replacement cost is $200 a square foot, but another carrier might say it's $150, and they may allow you to insure up to that point. So there can be different sort of requirements as far as the insurance companies to figure out, what that replacement cost is.
So I remember way back when I took my classes, you had to insure your property up to a minimum of 80% of the value in order to get, if you had a full claim, over your full fire claim, the house worth $100,000. If you made the mistake and insured it for too little, they wouldn't pay you enough to replace it, which I always found that to be fascinating too, because whose fault is it, right?
Yeah.
How do you figure out what the property is? So
you're right.
So even with you, with my properties, and I'm asking you because I really want to know.
Yeah. No, of course.
How do I know my properties are insured for the right amount of replacement value?
So what you're referring to there is called coinsurance.
Mm-hmm.
So there's varying degrees of coinsurance, and there might be no coinsurance in certain situations. Some like DP policies, for example, like the dwelling policies I referred to, personal lines policies, typically don't have coinsurance. You typically only see coinsurance on commercial policies. Actually, they don't have coinsurance for the most part. I mean, unless someone's seen something that I haven't. Typically, they do not have.
So what you're saying is, if the property's worth $300,000, you better have it insured for $300,000. You can't have it insured for $260,000.
So if there's an 80% coinsurance clause, and that coinsurance clause could vary, right? It could be 90, right? The higher it is, the less in premium you'll pay, basically. Because of the fact that there's a potential for a penalty, right? And if there's less potential it's actually the opposite. If you're higher up on coinsurance, you're going to pay less because there's a higher potential for that penalty. So you can pay a little bit less on the rate. So basically, the way it works is, and I can give you a story to kind of frame it.
Sure, that'd be great.
Whenever coinsurance was invented, let's say it was 40, 50 years ago, basically insurance companies had a problem. People would underinsure their property, right? Let's say a carrier wanted it insured. They said the replacement cost is $100,000. Someone insures it for $50,000, right? Another person, they want insured for $100,000. They insure it for $100,000, right? They both have partial claims, $10,000 claim, let's say, for example. Back before coinsurance was invented, they would pay the full $10,000 for both parties. So the person that would underinsure their property at $50,000 would still get the full claim paid out. They would have less value on their property, pay less, but they would get the full amount of their claim paid out. So
it only affected a total loss is really what you're saying.
A partial loss.
No. But what I'm saying, in that time, if their property's worth $100 and they insured it for $50 and it burned down,
right? Exactly.
They would only get $50,000.
They would only get $50,000. Right. So only in a total loss.
Right.
On the partial loss, they would get paid out the same way. And insurance companies say, you're not paying your fair share based on the value, right? So we're going to incorporate this coinsurance and basically penalize you for underinsuring. So if your coinsurance clause says 80%, you want to be within 80% of the replacement cost. If you're below that, let's say you're 70% the value, you're only going to get 70% of your claim paid out. So on that $10,000 claim example, that person would only be insured for
50% or $5,000.
50%, yeah, $5,000. Yeah.
Right, I got you.
Yeah.
But and then I'll tell you that's also that's great information too. So the first thing, so somebody's a starter, they've never done this before. What are the real differences in costs between one insurance company to another? I mean, I mean, even you, I've seen you call me up at rates and go, I've got this rate, or I got this rate, or I got this rate, and then we talk about the different ones. Why are there so many different rates, and why is it so complicated, and at the same time so easy?
Yeah. I guess, long story short, there's 3,000 insurance carriers in the country. Answer, right? So, there's a lot of competition. different carriers have different tolerance for certain things, and they're looking for certain types of business. Other carriers may not be, and their rates may reflect that. Maybe, their whole entire book of business in, habitational real estate is underperforming, right? So they are going to charge more than another carrier that is underwriting better and they're performing better, and they're able to charge lesser rates. I think the one thing that I would like to leave people with as far as kind of the pricing differences is the price you pay in premium with an insurance company is only part of the picture. The way we look at it at Brown & Brown is what's called the total cost of risk. So what you pay out of pocket for an uncovered claim, a claim that the insurance company doesn't cover, factors in to your total cost of risk. So it's not only what you pay in insurance, right? It's what's not covered by the carrier. So you could be paying $20,000 for your insurance policy, hypothetically, right? And another person could be paying $50,000. And if that, in that situation where the person is paying $20,000, they're not covered for a $100,000 claim. The person with paying $50,000 is, right? That person that's paying $20,000 for their policy is still going to end up paying $70,000 more into the system.
So, all right. So I get it. So it's really about what, self-risk or self-insurance, how much self-insurance you want to take on.
Right.
I mean, I even do this with my cars. I mean, I now have $2,500 deductibles. Because honestly, somebody, nicks my bumper or something. I don't even want to go through the insurance company. Forget about the cost. It's a pain to go through the insurance company. I'd rather just bring it to the dealer or to the body shop and say, hey, I fix my bumper. How much? And then they just fix it, and I don't have to worry about it. I don't have to deal with it. I don't have to deal with them pulling out the book and going, oh, it says it's this many hours. How much? And
going to depreciate it this much.
Right, and at the same time, because they know I'm self-paying, they typically take care of me too, which I find is great. But if my car gets totaled, I got pretty expensive cars with pretty big loans on them, and I want to make sure that they're protected as well.
Yeah.
So
that's
So
a really big point. Yeah. I mean, at the end of the day, you buy insurance for a catastrophic event, right? A partial loss isn't probably going to put you out of business. And, sometimes people feel like they can do the work for less anyway. So they're just like, I'd rather just do it myself or have, my team or, GC do the work for me. They can do it cheaper anyway. I'm just go doing it myself.
So what about putting properties in trust? Because we talk to people all the time about putting putting properties in trusts. How does somebody get insurance in a trust?
It's
it's the same thing. It just costs more.
Right.
I know. I understand.
No, it doesn't cost more. Actually, it doesn't. It's the same thing as an LLC. It's all the same.
I thought it was like $25 more or something in a year.
So
like something silly.
I think where that sort of has maybe come up is on the personal line side when you're insuring like rental properties in dwelling policies.
Okay.
Those carriers may have only be able to insure property that's in your personal name, right? On the commercial side,
okay,
there's no problem. Any entity type.
Okay, I didn't realize that. Okay,
it's the same exposure for the insurance carrier.
So we got about 30 seconds left. Tell people how they can get a hold of you, and what you can do with them.
Sure. So reach out to me on Facebook, Matt Heller, on Instagram, Real Estate Insurance Guy.
Real Estate Insurance Guy. I love it. Go ahead.
Yep. On our website, www.bbofpa.com. LinkedIn, any sort of social media, I'm there. Or you could feel free to give me a call, 215-866-0078. And the way I can help people is any owners in real estate or construction, really developing, owning property, anything of that sort. We can help sort of consolidate your insurance policies and potentially, lower your total cost of risk, which includes those claims that are uncovered, right? So we do a proprietary analysis kind of those commercial policies, and we make sure that there's no gaps that could lead to those uncovered claims. And at the same time, we're a national brokerage and have a ton of carriers that we work with. So,
All right, awesome. Wave goodbye, and we will see you next time.